Management and as the Chief Internal Auditor. He holds a Doctor of Business Administration from USIU Africa, a first-class honours BSc degree in Electrical Engineering from the University of Nairobi and an MBA in Finance from the Manchester Business School in the UK. His PhD study was on the influence of strategic leadership on the implementation of strategy in the commercial banks in Kenya. He is a member of the Institute of the Certified Public Accountants of Kenya and the CFA Institute. He is an alumnus of the Strathmore School of Accountancy and has a good command of the French language. Now, of course, we have Dr. Habil Olaka joining us today on the Trading Bell. He is the Chief Executive Officer of the Kenya Bankers Association. Welcome.
Thank you.
A pleasure to have you. In fact, as we talk about the Kenya Bankers Association, I do know that it promotes industry development, economic growth as well. But can you just give us a brief insight into some of the other, main areas that the KBA focuses on?
Okay. Besides what you have mentioned in terms of policy advocacy, we also find ourselves in a privileged position where we have got access to information from the industry in terms of feedback from the consumers of banking services. And that then enables us to position ourselves to be able to steer the industry in terms of initiatives that respond to those concerns or that feedback that we get from the market. So we have had a number of initiatives along those lines, like, for example, the modernization of the clearinghouse through what you call the check truncation system. It was purely a feedback from the market in terms of getting the clearinghouse modernized. Things like, for example, the Credit Information Sharing Initiative, which was basically to create an information sharing mechanism within the country to address the credit market. That's also an initiative of Kenya Bankers Association.
Okay.
More recently, we have got, for example, the PesaLink and similar kind of initiatives that we respond to feedback that you're getting either from the market or from the banks themselves in terms of initiatives that KBA can run with on behalf of the industry.
Okay, fantastic. So as we go along now with the conversation, let's take a look at the Finance Act 2018, because it was greatly debated. Of course, there were a lot of, apprehension at some point as to what's going to happen. And then when it did come into effect and we saw a lot of different taxes implemented, one of them was the increased excise duty on bank charges that went from 10 to 20%. Now, banks earned an aggregate of 70.6 billion shillings in fees and commissions last year, indicating that the National Treasury will raise at least 7 billion from the tax. So how has this new law affected the industry thus far, in your opinion?
Excess duty is a consumption tax. In other words, it's borne by the consumer of the banking services.
Yes.
And we do not see it having a significant impact as the numbers indicate. The number is moving from 10% to 20% and is doubling.
Yes.
And the impact may be felt like as if it will be some earth-shaking, kind of bomb that will hit the sector. I don't think so. I think the whole thing will depend on how the consumers will feel the impact on the increase in terms of excess duty. Now, I think that going forward, most probably the other services, because you see the banking services will now be compared together with other services, the alternatives that the consumer has.
True.
So instead of transacting in the banking sector, for example, he'll be thinking of, do I transact through, say, the mobile? And you see the excess duty on the mobile was also increased.
Yes.
So that may not be quite an option for the consumer. So you might find that it might have some moderate effect in terms of financial inclusion, in terms of the progress that you're making, to get people included in the formal financial services, and the increase in cost may have some minimal impact there. But I don't think it will be something that will be so earth-shaking as to have a significant impact in terms of reversing the trend in terms of financial inclusion in the country.
Okay, that's interesting. And as you said, it also does encompass a lot of the other options that consumers have. So there's not much wiggle room for them in that sense as well. But now the Treasury also, of course, increased, as you said, excise duty on mobile money, 12% from 10. And the Central Bank of Kenya Governor Patrick Njoroge said that during the Monetary Policy Committee briefing, he said the new tax could slow down cash flow into the economy. So despite what you've just said, would you agree with that then?
Yeah, I mean, at the end of the day, if the consumer feels that it's more expensive to transact through the bank, and therefore you find that most of the cash is actually avoiding the banking system, then it's not included within the formal economy. And I think that's the point that the governor is trying to bring across, in the sense that rather than being channeled through the formal economy, it's actually being bypassing the formal economy, and that can have some significant impact in terms of, for example, the lack of visibility. And it starts to bring challenges, like, for example, on money laundering and process of crime, because if it's not channeled through the formal system, it becomes difficult to detect and then address and control.
So it's harder to monitor, of course, if it's not
Yes,
a part of the formal
it's
chain.
outside the formal system.
Okay.
Yeah.
And another thing that, of course, has affected the banking industry, and that's since 2016. This year marks 2 years since the implementation of the Banking Amendment Act that introduced the capping of the interest rate at a maximum of 13%. And before that, the Central Bank of Kenya had the KBRR that gave a recommended base rate, and it allowed banks to factor in their premiums to cover perceived risks. But banks largely ignored that rate, as was seen, and they did charge exorbitant rates, as has been noted, which led to the calls for this particular ceiling to be implemented. Now, the IMF, however, insists that the rate cap has seen the credit taps for the private sector run dry, because banks instead are basically opting to lend to the government and corporates. So the Kenya Bankers Association, in fact, did have a lobby group, among others, presented the proposal that pushed the removal of the rate cap to the committee. So how does the banking sector in Kenya currently feel about the rate cap, and your thoughts on its possible removal?
Well, a number of issues come in there. One of them is the fact that I think if you look back at the movement of the rates in the market and how it has behaved, you'll clearly see the fact that we actually had caps earlier in the 90s, and before that we actually had caps in terms of, they were actually control rates, and then it was liberalized. So the controls were removed, liberalized, and then allowed to move in free relationship depending on the market movements. Now, and what happened was that in the past, by the way, we have got cases where the rates have come significantly low. I mean, if you look at the pre-1993 period, the rates were an average of close to 14% over that period. Now, in 1993, of course, we had the Golden Bug period and the challenges that were there about, yes, and rates shot up to an extent of almost 85% in the market. But that's a spike, and then it comes back. So if you look at the overall period, the rates were, behaving depending on the movement in the market. Now, even just before the law was passed in 2015, the average rates in the market were hovering around 16, 17 on average.
Okay.
Of course, the bigger borrowers, the corporates, some of them were getting rates of in the range of 10 to 14%. So the capping itself happened at a time when the actual rates were trending downwards.
Downward, okay.
So if you look at the trend, it's actually coming downwards. In other words, the rates can be controlled by other factors other than putting in a sledgehammer and putting in the legislative controls.
Yes.
So and the argument has always been that I think we need to identify the reasons why the rates are going up, and then address those challenges so that we can let the rates come down by their own forces, rather than forcing it the way we have done in Kenya. And worldwide, controls have not worked. What we need to do is, first of all, address the reasons why the rates are high, and then address those issues so the rates can come down by themselves. Now, of course, when the controls are put in place, I think they have got two issues there. One is on the deposit side, and then on the lending side. On the lending side, there's a cap which was put at 4% above the central bank rate.
Yes. On
the deposit side, there's a floor, the minimum that a bank must pay to an interest-earning account, which is at 70% of the central bank rate. Now, if you look at on the lending side, that the impact it has had is that because banks are not able to fit every available borrower within what is provided for in the law, banks have therefore been choosing only applications whose risk profile can be fitted within the allowed in the law. So anything that fits within 14% and below is what you advance money to. Anything that whose risk profile is above the 14%, you turn them away. And that happens to be the segment of the market that apparently, by the way, is most productive and contributes most to the GDP of the country. That's the SME, the households, and the like.
So it's ironic.
So the impact it has had is to slow down our economic growth effectively.
Yes.
On the deposit side, it was meant to give an incentive to the saver to be able to put that money in the bank to earn some additional return. Now the impact it has had is that one, we do not have adequate disposable income, and so between raising money for your very basic needs and having excess to put in a deposit, you rarely have enough for your very basic needs, and so there is no impact in terms of boosting the growth on the deposit side. So basically the law from both sides has not quite worked and pushed the market in the direction in which it was intended to be. Banks, of course, because of the cap, have found alternatives. So they either look for high quality borrowers who can fit within the cap, or when the government is pushing, or rather coming to the market to borrow, and they are a safe haven, banks will put money there.
Yes.
So as long as there's an appetite from the government, you'll always put money there, because on a risk-adjusted basis, it's much safer to lend to the government than to lend to a risky borrower whose risk profile is quite significant. And when you adjust the returns for risk, you find that the return from the government is much higher than the risk-adjusted return from an SME or a normal borrower.
Okay.
So I think the bottom line of it is that it has not worked in the way it was meant to have worked, and therefore we need to relook at it and address it. And KBA has been pushing for that. Fortunately, on the last parliamentary session, they actually relooked at it and adjusted the floor on the deposit side, but we'll still continue pushing for the cap on the lending side to be addressed, because they need to unlock lending to the SME, which is the most productive segment of the Kenyan economy.
Yes, true. All right. Well, as you say, then they should factor in the natural progression of the rates and let it flow with the factors that affect it naturally, as opposed to putting this ceiling, which is then costing SMEs and most smaller businesses that do contribute a great chunk, of course, to the economy, a majority chunk, if you will. So as we close up, banks have, despite this, continued to rake in profits, with their profitability increasing by as much as 18% as of the last couple of numbers that have come in, despite that rate cap. As you say, of course, the government that they can do business with, and more other sorts of customers as well. But as we approach the end of the year, what are your predictions in terms of profitability, despite the factors we've discussed that influence the banking sector in the country, as we close up?
I think 2018, you look at it with reference to 2017. 2017 was a particularly challenging year. We had the drought at the beginning of the year. We had the elongated elections that somehow just could not come to an end. And of course, we had the cap.
True.
So that, in a way, contributed to the fact that business was not picking up, and therefore credit was not flowing out, and therefore it affects the profitability of banks. Now, when you look at 2018, I think with that background, one is that we had some good rains at the beginning of the year. Elections are behind us. There was a handshake, which brought in quite some, unity and a feeling of the fact that elections are now behind us. We can now build on the framework that has been put in place. And then the caps, although not lifted yet, at least we can see there is some engagement, and there's a possibility that in the near future it would be, lifted. But also, banks are now, of course, using the option of the fact that the government has got the appetite for liquidity for the time being. And so I do not, in terms of profitability, I don't think banks will have such a huge growth in terms of profitability, but I think they'll do better than they did in 2017, in 2018. So
there's recovery, there's healing, and there's potential, of course, for the future.
Yes. So we can look at 2018 with a lot of optimism. And of course, as we look into 2019, I think with all these challenges being pushed out of the way, I think we'll see a much better 2019 than we have been able to see 2018.
All right. Thank you very much, Habil Olaka, for joining us on the Trading Bell.